Hey everyone, welcome to this week's In-Between-isode. So this week I'm going to be continuing the conversation we had last week about intrinsic value and the pressures in the bond market. On July 15th, 2015, there was an awesome article that came out in the Wall Street Journal that talked about billionaire Carl Icahn's opinions on the current market conditions. For anyone that doesn't know who Carl Icahn is, he's one of the best stock investors in the entire world, and his current net worth is $23.2 billion. So Icahn created a buzz when he slammed the CEO of one of the biggest pension fund companies, BlackRock Capital. BlackRock's CEO, Larry Fink, was somewhat taken back by Icahn's attacks of BlackRock because the company runs a lot of exchange-traded funds, or ETFs, that simply track the performance of underlying assets in the equity or stock market and the bond market. What I think a lot of people were missing in Icahn's underlying concern and comments towards Larry Fink is that Icahn thinks that the junk bond market is the emerging bubble in the current market conditions in 2015. To give you a little context, so I pulled two quotes from Carl Icahn just in the last month. So on June 19th, 2015, Carl Icahn said, "I'm concerned that we have a big fat bubble coming up. We have artificially induced low interest rates." And then on June 24th, he also said that, "I believe the market is extremely overheated, especially high yield bonds. If more respected investors had warned about the market in 2007, we might have avoided the crisis in 2008. So both of those quotes by billionaire Carl Icahn. So this is Icahn's fundamental issue with the market right now. He and billionaire, even Ray Dalio, both have said that they believe that the $15 trillion junk bond market is the emerging bubble. When Icahn attacked Larry Fink about the junk bond ETFs, my opinion is that Icahn wasn't making an attack against the ETF vehicle, but the market class of junk bonds that it tracks. The market for junk bonds has soared up to 45% since 2010, and that makes total sense. Remember what we talked about last week in the In-Between-isode. For investments that are considered safer, like the S&P 500 index or the US Treasuries, you're potentially getting a rate of return of 4% for the S&P 500 and about 2.5% for the 10-year Treasury. As a result, many investors don't like those low yields of under 4%, and as a result, they've been piling into this asset class that gives them a higher return, but the cost is increased risk. And that's why the junk bond market has been going wild. So here's the fundamental problem and the crux of the issue. The market price of bonds move in the exact opposite direction of interest rates. That means as the Federal Reserve makes the move to increase interest rates before the end of the year, which Janet Yellen has become a lot more hawkish on in the last week alone, the volume of investors that might flee the junk bond market may be substantial. If you don't think things are getting a little irrational, think about this. In Europe, 25% of the bonds being issued have a negative interest rate. I have to ask myself, why in the world would you pay someone to borrow money from you? That makes no sense whatsoever. So here's the key takeaways. It's twofold. First, if you've selected yield before safety, you might be in a position to learn a really difficult lesson. You always want to consider the safety first and then the yield second. And that's something that comes straight out of Security Analysis by Benjamin Graham, which is the book that Warren Buffett quotes as being one of the most influential books that he's ever read. Secondly, if you've selected a long-term bond, the magnitude of that lesson might be profound. Remember, the longer term of the bond, the more dramatic the change will be as rates change. So that's all I have for you this week. If you've got investments in bonds, especially long-term and high-yield bonds, some of the wealthiest people in the world are starting to talk and send warning signals. As always, at the Investors Podcast, we like to try to pack a lifetime of experience into only 5 minutes.